Hey, welcome back to The Dive. Today on the show, we have the editor of Silver Stock Investor and the author of The Great Silver Bull, Peter Krauth. Peter will be answering some of our questions about inflation, the Fed's rate hikes and their impact on the economy and the mining sector, China's role in the silver market, silver and the EV revolution, silver's recent price action, commodities he's excited about for 2023, and he's also going to talk a bit about the main takeaways from his book titled The Great Silver Bull. Hey, Peter, welcome to The Dive.
Thanks, Cassandra. Happy to be here.
Yeah, thank you so much for joining us today. Okay,
My
now
pleasure.
let's start off with macro. The U.S. December CPI print came in at 6.5%, down from 7.1% in November. What are your thoughts on where inflation is heading from here?
So I think that inflation may actually continue to fall a little bit. We're looking back over a year and we were at very high rates at that point. So when you look year over year, it's not surprising if you see it come down somewhat. It's hard to keep up that kind of high level of, eights and nines, 9% levels. But I do think that even if it continues to fall, although it's obviously because the Fed's being aggressive, I think that we could still see rates, if they do bottom, I think the bottom probably is going to be somewhere closer to about maybe 4 or 5. I seriously don't see rates getting much below 4%, although the Fed's aiming for 2. That I think is, sort of dreamland. And something to note is if you dig a little bit deeper in the inflation rate in the numbers, the Fed follows the core CPI. And the core CPI actually was up 0.3% after rising also in November. So this December was up 0.3%, and in November it was up 0.2%. So the core CPI, which the Fed tracks very carefully, is actually going up. And it's one aspect of the inflation rate that was actually down, which was gasoline. So food prices were also up. So, it may actually be, this drop. I'm not saying it won't continue. I do think it will. But I do think that we have to be careful in terms of reading too much into how much the inflation rate can continue to fall. This may be a bit of an anomaly in terms of how it happened this month.
How do you think that the Fed raising rates affects the global market and mining sector?
So it definitely brings headwinds for the mining sector because raising rates helps push up yields on bonds. When investors look at what they invest in, they have choices. They have regular stocks, they have bonds, they have within stocks, they have different sectors like mining, for example. So you're mining for commodities, and commodities are priced in dollars. As interest rates go up, it makes the U.S. dollar stronger, and so investors compare what they're getting on bonds or what they're getting in cash in a strong dollar if it's rising compared to other currencies. And so relatively, it makes those sectors more attractive. Now, that may have already run its course because if you look at what happened with the US dollar, it looks like it peaked back in September, October. And it's fallen. The US dollar index has now fallen from 114 to about 102 right now. That's a huge drop in a short time. I think the market is forward-looking. It sees that the Fed is going to, before too long at least, stop raising rates, even though they're saying that they're going to be aggressive and aim to get inflation back down to 2%. Again, I don't see that. So the market is pricing in at least a peak in rate hikes. And if you look at what the 10-year Treasury has done, that was yielding 4.2% back in October, and we're at 3.4%. So that's I think it's a 22 or 23% drop in the yield on the 10-year Treasury. So with a drop in bonds, that starts to make precious metals more attractive because there's less opportunity cost. So it is tougher for mining to see higher rates, but I think the market is starting to price in an end to higher rates. And I think that if you look at what's happened with precious metals and commodities in the last 3 months or so, they've really taken off. And I think the market's forward looking and sees them heading higher.
What impact do you think China's reopening will have on the global economy?
So yeah, that's an interesting one because China consumes in many commodities is the consumer of at least 50% in many cases, copper, coal, zinc, lead, all kinds of things. And so China reopening suggests that, we can get a lot more demand in these commodities. And I think that's one of the reasons that we've started to see commodity prices tick up as well. Um, that's going to, if that kind of demand is interesting, because it could help also reverse what we've seen in terms of inflation coming down. And if the prices of commodities start to pick up, that influences inflation. Of course, things will start to cost more again. And so this sort of lull that we've seen in inflation really may only end up being rather temporary, and that could help sort of reverse this relative weakness, I guess, if you want, in the level of inflation just recently.
CME Group, the organization responsible for setting silver prices in London, announced that China Construction Bank will become an official member of the silver price process. What role do you think that China has on the silver market?
So for me, this is two parts, because one, I think that as part of the silver pricing process, I think so China's going to pretty much toe the line, and silver prices in terms of futures prices will not really change very much. But I do think that silver is China is a huge consumer of silver as well. They're responsible for 80% of solar panel manufacturing. And solar is the single biggest industrial application for silver. So at about 12% of the entire annual silver supply. So with China reopening, and with China consuming so much silver, I think that again, I don't expect them to change how silver gets priced or the ultimate price, but in terms of demand, I do think that that part of it is going to help push silver prices higher, and for physical prices to start catching up for futures prices to gradually start catching up to physical silver prices.
All the legacy auto companies are now starting to turn their shift from gas vehicles to electric vehicles. How does silver fit into the EV revolution?
So silver is absolutely crucial. It's part of so many different components and utilities within a car, not just modern EVs and that sort of thing, but even the sort of traditional internal combustion engine vehicles. So silver is about something like 18 or to 25 grams of silver goes into a traditional internal combustion engine vehicle. But in an EV, as much as 25 to 50 grams of silver goes into each car. So that's nearly twice as much. And we've sort of reached that crucial point in the adoption of EVs, at least in the U.S. That's we've certainly surpassed it in a lot of other places like Norway, parts of Asia and Europe, and so on. But that in a big market like the U.S., we've passed that crucial adoption point. And so EVs are becoming considerably more popular. Silver, as I say, is crucial to EVs, and there's a lot more silver that goes into each vehicle. So they have a huge influence on the amount of silver that's needed. In fact, it's about 50 million ounces per year that goes into the automotive market, and in part, at least, because of the adoption of EVs. The Silver Institute thinks that within the next few years alone, we're talking the next maybe 2 to 3 years, or maybe actually more like 4 or 5 years, it could actually double from 50 to 9, almost double from 50 to 90 million ounces consumed of silver every year just for the automotive market. So it has a really big role to play.
So silver's had a really good run recently. What factors do you believe have influenced its present price movement?
So, like all markets, I think silver looks forward. And so I think silver, like gold, sees an end to Fed rate hikes. not necessarily an immediate cut in rate hikes, but at least an end to hiking. And so that sort of, relative peak and relative weakness, I think, suggests to silver that it's going to have to compete less with higher yields from bonds and a higher dollar. As I said before, bonds have peaked in yield. The dollar index has peaked going back about 3 or 4 months. So silver, looking forward, sees that and realizes that there's a peak in Fed rate hikes. There's eventually going to be easing from central banks, and so that's when silver shines. And it's looking forward to that day. It's really starting to come.
So beyond silver and gold, what other commodities are you excited about for 2023?
So I think that uranium has a really important place in terms of if we're really aiming for a low or no carbon future. Uranium is absolutely crucial. Not only is it ideal in terms of what we call baseload power, because it can provide electricity and it can do it on a 24-hour basis, unlike solar or wind, for example. And it does it with no carbon emissions. And so, the cost of the fuel to a nuclear power plant is tiny relative to the construction of the plant and running it. And so even if uranium prices are considerably higher, that will not deter utilities from buying the uranium. They have to buy it to keep the lights on. And what we've seen in the last few years with this sort of new trend towards deglobalization, especially with the war in Ukraine and energy security that so many countries are really aiming for more and more right now. The U.S. has, for example, started a reserve where it's kind of like its petroleum reserve for uranium, and it's starting to buy uranium from U.S. producers to rely less on foreign suppliers, because nearly all of U.S. uranium that goes into U.S. Nuclear power plants actually comes from foreign suppliers. Very little is locally produced. And so they're very much dependent on sources of that commodity from outside the U.S. And that's not a comfortable place, especially when you see what's happened, as I say, again, in Ukraine and what that did to Europe in terms of their energy supply.
Okay, so last question we have for you here, Peter. What is the key takeaway from your book titled The Great Silver Bull that investors should know about?
So I think that what's crucial to know and understand about silver is that we are still relatively early in a long bull market. There's a long way to go. Silver does extremely well in precious metals bull markets. In the 1970s, gold was up, I think it was something like 1,400%. Silver was up 3,700%. And so that was a tremendous run. It was also a huge outperformance of gold. And I think that we're going to see that this time around once again. Silver has a long way to go, and it's very cheap. The traditional bond and stock mix portfolio has really started to fail. We've been through a 40-year bull market in both stocks and bonds since about 1980 up until about 2020. Or at least 2022, we saw both of those huge sectors, stocks and bonds, peak at the beginning of 2022, and it was a very, very rough year in both stocks and bonds. And although they were both down, gold and silver were flat. And if you can at least not lose money in a year when other sectors are way down, then you're actually very much ahead. Not losing money, not necessarily having a gain. And not losing money is still quite the outperformance. And in the last 3 or 4 months, gold is up about 12% and silver is up about 32%. As we speak, gold is up over $1,900 and silver is up over $24 right now. Silver really, as I said before, outperforms gold in bull markets. It's still, believe it or not, the only major metal that is more than 50% below its all-time high, which it reached in 1980. So it's relatively very cheap. And if you account for inflation since then it's about 85% below its all-time high. And, gold is actually much closer to its all-time high. So relatively, silver is very cheap, and it produces, sort of life-changing returns, I'm going to say, both in the metal itself and in the stocks that search for, explore for, and produce silver. So it's definitely a sector that investors want to be exposed to. And although it's volatile, you don't need to there are ways to balance out the risks that come with volatility. You can do things like have smaller allocations. You can position size in your stocks and so on. But it's definitely something that you want exposure to going forward.
Okay, great. Well, thank you so much for coming on with us today, Peter, and sharing your expertise with us and our audience.
It's been my pleasure, Sandra. Thanks so much.
Thank you all so much for tuning in today. We will be back again tomorrow with another great interview. So be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.